And welcome everyone to our latest Stamford Brown SB Talks podcast. Today is March 23rd, and I am once again joined by our Chief Investment Officer, Ashley Owen, to discuss all things investment markets, economics, outlook, and obviously it's been a very eventful last few weeks for the world on a number of fronts. So unfortunately, the unfolding situation in Europe. Welcome, Ashley.
Welcome, Vinny, and welcome to all and sundry around the world, wherever you are. Good evening, good morning, good night. Yes, it's been an interesting monthish since we had our last one.
I might quickly just start, Ashley, if I can, by congratulating you on your most recent monthly update that you wrote to our clients a couple of weeks ago now, particularly detailing the unfolding events in Europe and some of the interrelationships between that and the history of conflicts and the impacts on share markets and other markets. Obviously, a horrific humanitarian situation that's going on and appears to be worsening by the week. But the analysis that you did from an investments and markets perspective, I think, was second to none. So well done on that.
Thanks for that. It's always hard to write about wars because one part of you says, well, look, let's put money aside and focus on the people, and everyone's got friends and family and colleagues, and you look at the humanitarian problems and literally killing civilians at will, pot shot. So it's very hard to talk about money, but it is the aim was to try to get people to put aside the initial knee-jerk reaction, which might be just to sell everything and wait on the outsides and for things to settle down. But of course, that's so I'm trying to take the knee-jerk aspect out of decision making and to sit back and look more rationally while all that goes on. We can say,
look through the immediate understandable alarm
yes,
as the situation unfolds.
Yeah, so the point of that was to I went through about 50 recent wars, military conflicts, civil wars, uprisings, including all through the Second World War, Pearl Harbor, the bombing of Sydney, the bombing of Darwin, September 11, 50 different events over the last, Vietnam War, in and out of that, the Korean War, all of the Chechen wars, Georgian wars, Azerbaijan, Kosovo, all of those. And I picked ones which have sort of global input, global impact, particularly on Australia and commodity prices, share prices. And the point of that was to show that share markets have a tendency to, or investors have a tendency to sell off quickly and then immediately realize they've done the wrong thing because the opposite signals come out. So even things like the start of Second World War and the bombing of Pearl Harbor and major events that involve major players like that, the bombing of Darwin, the bombing of Sydney, literally 100 yards away, we had Japanese subs bombing ships in Sydney, killing sailors in 1942 May. So these sound scary, and indeed they are, but for share markets are driven by very different things, and a number of things are common themes throughout all of history, and that is that wars, by and large, create instant surges in demand for stuff, everything, food, material, commodities, metals. So that's consistent throughout history, literally over thousands of years of human history. So when you look through those, the demand for metals, the demand for energy, the demand for food, the demand for building products, all of these things wars create instant demand for those, and that is instantly reflected in commodities prices, all of which flows through to share prices ultimately in earnings and profits and dividends.
And the parties at play in this one, I was going to say, Russia, obviously a major energy supplier to Europe and the EU, and Ukraine, a major pipeline transit point for a lot of that energy.
Yes, it is interesting, and I can talk about sanctions and the direction of sanctions and where they might lead, and also the impact of sanctions. And in a nutshell, sanctions by and large don't work. For example, 2018, Trump started a trade war with China. Australia hopped on board very vocally. China then retaliated over many months, over a couple of years. Every single industry in Australia has been being hit by China's bans on exports, from food and energy and all sorts of things, except iron ore. But all of that, and now it's cracked down on iron ore from Australia as well, but all of that shifted our focus, Australian companies' focus to other buyers, particularly in Asia and now Middle East and now Europe. So the impact of those sanctions from Chinese action on Australia has been universally good net because we've had this massive export boom in the very years that China's cut us off in pretty much everything. You know, coal, beef, lobsters, food, milk, all of those things have been banned by China to import from Australia. But all of those industries, with a few exceptions, have found other ways to sell their product globally, despite COVID and despite all the problems. So that's just one little example of the way that sanctions don't generally have their intended effect.
Certainly medium term, so short term have an impact, but
yes,
the economies, the trade finds a way around it.
Correct. So in the case of Europe, Germany is the centre in a lot of ways in Europe, and they've also been the centre of a very pro-Russian attitude over the last 20, 30 years from Gerhard Schroeder, who's on the Gazprom board, by the way, Merkel. Germany's been very close to Russia since the reunification in the 80s and 90s, sorry. So you find now that Germany and the rest of Europe totally, but Germany in particular, is heavily reliant on half of its energy. It gets all of its oil, it gets half its oil, half its coal, a third of its coal, half its gas from pipelines through Ukraine from Russia. So Germany and Europe's allowed itself to become too reliant on what is now a belligerent power. So, and therefore you see Germany's reluctance to do anything about it. So for example, when the sanctions were placed on it by US and UK a couple of weeks ago on Russian banks and Russian trade and Russian transactions.
And some of the oligarchs as well.
And the oligarchs, but in the case of Russia, they specifically carved out oil and gas and coal sales to Europe. They weren't banned. They specifically carved out payments for exports through the SWIFT banking system. They're allowed as well. So there's two, and which of course has created this great energy crisis, and the oil price is shot above $100 still today. Coal prices have skyrocketed, metals prices have skyrocketed. But if you think about the way, the two ways the sanctions can go and the impacts on markets, the first reaction will be to say, well, put your hat on and say, Russia are the bad guys, sanction them, stop all exports, stop all payments, let them suffer. There are lots of problems, although it might sound good when you say it quickly, there's lots of problems ethically and in principle as to why we're not punishing 140 million Russians, we're punishing one guy and his billionaire mates and his cohorts and the army. So we don't really, we as a world don't really want to make the Russian people suffer too much. Mind you, if we push them to a point, the Russian people have had enough of this. Those that remain, most people with a brain have got out of Russia over the last 20 years with Putin in power. But there's a lot of Russian people there who are just workers going about their jobs, and we don't want to make them suffer too much. However, we would like them to rise up and get rid of Putin. So there's quite
a dangerous game, and trying to push them to the point of desperation, such that they might overthrow a dictator.
That's very much a sort of a plan C. The more likely outcome is going to be that Putin will retain power, and if sanctions push his country too far, he's got. It's actually not as bad as it sounds. They've got foreign debts of about $800 billion in foreign debt. They've got reserves of about $700 billion US foreign reserves. Now, half of that has been locked up because access has been closed to US dollars. The next biggest chunk of reserves, foreign reserves that Russia holds, are with China. And in gold. Now, though Chinese reserves and gold is very easily convertible and tradable around the world. So Russia in 1998 defaulted on its debt, and that was a bit of a rankle in world markets in 1998. And that caused hedge funds to collapse in the long-term capital management. That was a minor sort of grade C sell-off in global markets in 98 when that occurred. This time around, Russian economy and Russian reserves are far more robust and far wealthier. So Russia, if it doesn't get paid for a single barrel of oil or gas or coal ever again, it can happily repay its interest on its foreign debt for 20 years to come. So, and of course, it's going to get revenue from sales of energy. So it's not going to default on its foreign debt, most likely. It did the other day, for example, Putin did the other day say, we're going to pay our foreign debt, which is owed in US dollars. We're going to repay our foreign debt in rubles since you've crashed our ruble 95%. That was a bit of an idle threat that didn't need to occur. So Russia's in quite a strong position economically. If the West screws them down too hard and makes them suffer economically, so they can't pay for their war material, they can't pay for their troops on the ground, which is what happened with the Roman Empire in 400 AD, what we don't want to do is cause Russia to do a Japan pre-Pearl Harbor. In World War II, what got US into the war in World War II was Pearl Harbor. All the blockades and all the sanctions against Japan in 1941-42, 1940-41, Japan was backed into a corner. A madman with a lot of bombs is backed into a corner. So what he did was he lashed out and hit Pearl Harbor, which was the dumbest thing to do because they got clobbered. What we don't want to do is push Putin into a corner so he has to do nothing else but throw chemical weapons or nuclear button. That's something we don't want to do in the West. And by broadening sanctions, by making sanctions absolute, we're pushing a madman into, I'll say madman in a second, into a corner where he's likely to do some radical things which the world doesn't want to see, including a nuclear war. So the course of sanctions is very important for global markets because it influences interest rates and commodities prices, in particular oil and gas prices and coal prices. It's going to be interesting to see how Biden, and Biden's the key player in this, and secondly, Xi Jinping react to that sanctions and helping Russia get out of Ukraine in whatever way.
I was going to say, having a method to even step back from this without loss of face and without seeing they've been defeated, it's not an easy path to navigate.
Correct. So I think if you remember, about 5 years ago, North Korea started to get cute with missile tests and nuclear tests and ICBM tests and threatening, and Trump went over there. So it was a bit like North Korea was the embarrassing wayward child of China, and China was trying to contain them and say, yeah, get back in your box, we know you're there, but just don't do anything stupid. It's a bit like that with China, which is the big power, 20 times the size of Russia economically, and Russia. China, who was very pro-Putin and pro-Russia leading up to the Olympics and all that, no limits, friendly deal. You can't help but think that Xi Jinping saying, get back in your box, we know you're there, we know what you want, we'll support you, we'll buy your oil and gas and coal, and particularly wheat and food products, we'll buy all those to help you out of sanctions, but we don't want to be too cute by supporting you too directly, in the same way as the American doesn't want to get too cute and going into their feet on the ground in Ukraine. Both of those, Xi Jinping and Biden, do know what they're doing, and they're trying to navigate around this without being too direct. So it doesn't need to end in war. I mean, the Cold War of the 50s, 60s and 70s didn't end in war. There was a peaceful outcome. USSR collapsed and the rest is history. So conflicts like this and massive escalations, including nuclear scares, don't need to end in all-out war. And we're relying on both Biden and Xi Jinping to do what JFK and Brezhnev did, Khrushchev did, sorry, in the Cuban Missile Crisis. There is a common sense way out of this. It's a moving feast, of course, but that's more likely the game A, if Biden and Xi Jinping can remain outside but still involved.
Well, hopefully we see some sort of de-escalation soon from a humanitarian point of view.
Yes, yes.
Now, the year started before Ukraine and Russia and Europe hit the headlines in more recent weeks. The year was very much about the year where we knew interest rates were going to have to start going back up, and the expectation was that the US would be making their first move at the Fed meeting in March, and that did occur. We went up by 25 basis points, as largely flagged and telegraphed to the market by Fed Chair Powell.
Yes, so the Ukraine-Russian war has had an impact on all of that. Last year, 2021, was all about rising inflation and central bankers asleep and letting it get out of control. This year, or headline inflation, this year, it's all about central bankers waking up and raising rates to try and kill inflation. So everyone agrees, including the Fed itself, that it kept rates too low for too long, and they've dug this almighty hole from zero. They've got to get back to 3, 4, 5% cash rates in the US.
And for up until reasonably recently, we're still maintaining that the rate rises might not even start for another couple of years, which was incredibly dangerous.
And the RBA stands out as the only central bank in the world still asleep on this. So, and we'll talk about that, because that has implications for house prices in Australia and economic activity in Australia and interest rates and mortgage rates in Australia. But the US is still the driver for global markets, including Australia. What happens in the US echoes around the world next day in Australia, regardless of what happens here. So elections come and go, governments come and go, RBAs come and go, but the US still drives global markets, including Australia. So in the case of the US, they have quite a few problems on the inflation front. Pretty much everything, rent, housing prices, clothing, food, energy, everything is going up in the US, some by double digits or more. Their headline rate is nearly 8%. Their underlying rates are, the core and the this, that, and the other, all of their underlying rates are sort of 5s and 6%, which is well above Powell's, average 1 to 2% range. That's now out of the water. Now, to date, central bankers have said inflation rises, the price rises due to supply constraints, COVID lockdowns, mines being closed, bad weather, all sorts of things, shipping channels closed. Those reflect in higher prices because of supply constraint. They are not something that's going to be built in inflation. You need to attack with interest rate rises. So that was the base case last year. This year, if you leave that run too long, high inflation, rising prices does, where it bleeds into real inflation, which has to be attacked by rising interest rates, is where the higher prices start to affect people's behavior. They start to say, look, I'm going to buy. I remember when I was buying 20 years ago, all my friends had these massive flat screen TVs, which were a big new thing, and they would cost $30,000, $40,000 for a TV, and you got 1 pixel per inch and you couldn't see it. But it was big and it was expensive. 40 grand for a thing you can't look at. And then I kept saying, I noticed that a bit like computer chips, every year they'd halve. So what cost 70 grand 1 year, same thing, better quality, high tech, more
the technology would evolve, the supply would increase and prices would come down.
I put off playing that game until I remember, about 15 years after that, I finally bought one for about $400 from Dick Smith, and it was 4,000 times better quality than the things that they spent $70,000 on. It was bigger and better because prices just collapsed every year. So where price rise, now all of those things, by the way, are now increasing because the cost of chips has gone up because of a drought in Korea 2 years ago, Taiwan 2 years ago.
Lots of logistical supply chain challenges.
Metal prices have quadrupled over the last couple of years since COVID. Oil price has gone from minus to 140. So everything is now more expensive. Now, if that changes people's behavior, so they say, oh, that's going up too quickly, I better buy one now, which is what's happening now. Everything's going up in price. I'll buy 3 instead of 1. I'll accelerate that purchase because I can see it costing more next year. That's a behavior change which leads to prices rising on an ongoing basis, not just a one-off spike. So that behavior change is starting to happen now across the board with everything, building materials, everything. So that's the sort of thing that'll make, inflation was running at 0, 1% for years and years and years, and COVID hit, then it was the same. Now inflation is running more likely at 2s and 3s and maybe 4% across the world, and including Australia. And that's real inflation that'll keep rising on a line rather than a spike and down again. Last year we saw a negative spike then up again. Now we're seeing the actual plane rising. So that's where central bankers have said, right, this is getting serious. We've got to start raising rates. Now, with oil prices having a massive surge because of the Ukraine war, they jumped up to $120, $130, $140. Bear in mind, they were negative. This time 2 years ago, you had a negative oil price. They were sending tankers out to sea with no captain because they just didn't want to have the oil. Nobody would buy the oil. They were literally putting it out to sea. Nowadays, it's $100 and more. And even now, it's back to $100. So that's flowing through to everything you and I do and buy has an oil price component in it. Everything is shipped in a truck. Everything goes by car. So everything is shipped. So that means that the question for the Fed was, got to raise rates. Do I do it, in one nice little quarter point? Like, remember, leading up to the GFC, we had 17 quarter point rises in a straight line. This time around, they could have said, right, what's happening in Europe? inflation's surged because of oil prices, which will bleed into spending. So we could actually go for a 0.5 point rise and then maybe aim for 2-ish% this year rather than 1-ish% this year. Alternatively, what's happening in Europe is the inflation is causing spending to collapse in Europe, production to collapse, ultimately jobs will collapse in Europe.
So you're seeing the inflation, the price hikes in energy prices, their electricity bills, they're filling up their cars, seeing them pull back dramatically on other spending, on discretionary spending.
They can't drive to work. They can't get petrol in the car to drive to work. They've got to line up. It's like the 70s. You've got to line up for a day to get a tank full of petrol. So that's the sort of thing which causes a production collapse in an economy, an economic slowdown or stagflation, high inflation, stagnation. So that's a 70, certainly for Europe, the outlook is like a 70s style stagflation where you have productivity going down, earnings going down, revenue going down, economic activity output going down while you've got high inflation. That was a 70s story. That's the most likely output for Europe. Australia and the US are a little different because we're energy exporters and commodity exporters. The largest exporter of oil in the world, producer of oil in the world, is now US. And then US and Russia is close second. So it's in a different position than what it was in the 70s. So because of that slowdown in Europe, plus a completely separate slowdown in China for other reasons, property collapses, COVID lockdowns, you've got half the world's economy, Europe and China, in a massive, in a quite a severe slowdown, unrelated but together. So Fed could have easily said, let's just not do it yet because
stop and wait.
Stop and wait. So the 0.25% rise was a bit of a middle ground between those two risks. Now, what they did, which was expected, you know, pre-war, that was expected. The second big outcome of the Fed meeting on the 16th of March was that rather he'd upped the ante for the expected rate rises this year. So he said, calendar 2022, we're aiming for 1.9% Fed rate, which was about 1% above what everyone thought prior to that, which reflects his saying, look, this is getting serious, we need to go a bit faster. Now, because of the way that he talked that through with the public for months and months leading up to it, what the Fed doesn't want to do is create surprises. There's too many cases of surprise Fed moves over the past literally 110 years of Fed history. There's too many examples
Taper
of Fed
tantrums,
surprises.
modest tapering and moderate tapering, etc.
Greenspan, and so you don't want to have that. So what he's been careful to do is to say, we're going to talk it to death so you know what we're going to do. We're not going to lead the market. We're going to follow the market, to take the words of Ian Macfarlane, who is on our committee, ex-RBA governor. Fed's going to follow. He's not going to make great surprises. Where he wants to change course, which he did a couple of weeks ago, he'll tell everybody, I've changed course, here's why, here's what we're going to do, here's what when we're going to do it. So the lesson of late 2018, where they had literally 4 rate hikes in 2018, if you include December 2017, he went mad trying to get rates back up to 2-3%. He got them up to 2.25%. Stock markets fell around the world 25%. So he said, we can't have that. This is pre-COVID. Then you had COVID. They went hell for leather out to try and help markets. He's going to be very careful not to have any negative reaction, even if it's just share prices falling, let alone jobs falling. So I think
certainly the initial market reaction to that news coming through in recent weeks has been broadly positive. The market's certainly been up.
Correct. So we're still bullish on shares, and even despite the war, despite the rate hikes coming up, because we've done a lot of work over the years, which we publish and we talk about, which demonstrates that of all the 133 rate hikes since the war, by and large, they're very good for share markets, particularly those in the early stage of rate hikes when the rates are coming off a low base.
Can we talk to Australia perhaps for a minute? Because we're a bit slower to not perhaps wake up, but come to the interest rate party. We keep deferring.
Yes.
When the decision might come, when the rise might start. Only as recently as late last year, we were still maintaining a 2024 first move, which seemed farcical.
Yes, the Philip Lowe spent 30 years studying how to kill rate hikes and how to kill inflation spikes, i.e. during the 50s and the 70s and 80s in Australia. So inflation is a bad thing. Inflation is legislated theft. A government's policy to have inflation at 2 or 3% is a government's policy to steal the wealth from its citizens of 2 or 3% a year. So it is a institutionalized government aim to steal money from people through inflation. So it pays back its interest on debt with deflated dollars. So central bankers have always liked some inflation, 1 or 2 or 3%. That's why there's always a target of positive inflation. Why? Because it encourages people to spend. Spending is good because it creates jobs. What you don't want to have is Japanese-style deflation, because that means people just don't spend and they don't create employment. So some inflation, very low inflation, 1, 2-ish%, is seen as a good thing because it does keep spending ticking along. Particularly if it's stable inflation. The most important thing is stable inflation,
consistent,
not jumpy inflation.
Moderate inflation, good for the safe functioning of the economy.
Correct. So the Phil Lowe, the RBA governor, has now decided that inflation's good, and he's lying awake at night dreaming out of ways to create inflation. So it's a bit of a turnaround from what he's been taught over the last 30 years. So he tried to set the scene for no rate hikes until mid-2024 by setting a bond peg, a 3-year bond peg from 20 going out to 24. He pegged rates at 0.1% for 3-year bonds, which means that the RBA bought pretty much every bond in the market to try and depress the price to 0.1% for 3-year bonds. That failed spectacularly in about October, November last year, when they literally ran out of money. They've racked up about $8 billion in losses, which we've got to pay for as taxpayers. We've got to tip in capital next year out of the budget, which we're going to find out in a couple of weeks' time. So he abandoned that rate peg, which is probably go down, had the war and other things not being more important, that would go down as one of the great faux pas in central banking history in Australia anyway. Interesting to see how that worked. But getting back to the main point, Aussie share prices are driven by what happens in the US. The Australian market, if the US decides to to go for 6 or 7 rate hikes, and maybe there are 2 or 3 Fed members. The Federal Reserve in America is not one bank; it's 12 regional banks, because that were set up to be a very decentralized 12 regional banks that run 12 different economies: agriculture,
they get a vote,
timber, shipping. So they all vote. Now, most of the time they vote as one, and they have 1 rate hike. There's 2 or 3 members which are saying quite well regarded, well respected members saying, look, we got to be doing this quicker. So there's not going to be a fallout within the Fed, but there's a lot of pressure to hike rates faster than simply 1 quarter per. I think there's about 6 meetings left this year, which is 6.25% rate hikes. Assuming the war in Ukraine goes as it's currently going, with a stalemate or withdrawal or no grand peace breaking out, but no nuclear war, you can expect another 0.25% every month until Christmas, if not maybe a double rate hike somewhere in there as well. Depends on how the numbers come out, but so far, every element in the spending pie in the US is going up, ultimately because of supply constraints, feeding into energy, food, materials, metals, everything, goods. So the other point of interest for Australia is we've had this massive housing boom driven by 2% interest rates. The RBA deliberately and consciously and publicly set out to create a housing boom in October, November 2011, when it started its rate cuts going into the the whole of the 2010 decade.
Well, there was probably still lingering concerns, certainly internationally at that stage, that our housing market was in a bubble back then, and that it should experience the sort of corrections that had been seen in pockets of the United States and Europe.
Yes. So US housing market collapsed wholesale. It collapsed across the board, 40%, literally across every city in America, some worse, in 2005, 6, 7, which led to the GFC, the subprime crisis, the banking collapse, and the GFC recessions, which echoed around the world. Australia has built a monumental pile of household debt supporting a housing boom. A lot of people, you and I have all got friends and family who bought places on 2% mortgages that are fixed for 3 years, fixed for 2 years. A lot of people have bought flats off the plan on fixed rate mortgages for a couple of %, and they've bought 3 or 4, you put it on your credit card. Nowadays with deposit guarantees, you don't need any money to buy a property. A lot of those will come unstuck when rates rise, because if rates are now 2% interest rates and mortgages, probably in 3 years' time when those roll over, they'll be rolling into 5-6% P&I mortgages where they've got to pay principal as well. Or if they're lucky, they might refinance into fixed rate at 4%, which will double their repayment. So that relies on a lot of things going right. That relies on rents rising, which they are, because construction stopped. That relies on population coming in. Australia's always been driven by population growth. That's stopped currently, but we assume that will start to rise, get back to normal immigration numbers over the next year or two or three. But that's a big if. Maybe it will, maybe it won't. A lot of that came from China. Basically, Xi Jinping said, don't go to Australia. They're a racist country. Don't go and study in Australia. Don't go and visit Australia. Don't go and visit koalas in Australia. Don't go and live in Australia. So some of those will bleed out. But that whole mass tourist student immigration from China, I suspect, is on another plane from now on. But there'll be plenty of people out of Europe, Syria. There's plenty of people who want to come to Australia. We've got to open the borders first. But that underpins house prices. So you'll assume that will be okay in the years to come. You'll assume rents will keep rising because you've got these massive NIMBY councils and supply constraints on land in Australian cities. So that will be okay. It's a lot of things are riding on those things going right, so that when people refinance from 2% to 6% in a couple of years, they'll be okay. I've always been bullish on property in Australia for those structural reasons: demographics, geographics, immigration,
and the scarcity of land close to the major cities.
So I'm primarily being bullish on property forever. However, they do rely on a lot of things going right, and probably it won't be an endemic problem, won't be a system-wide problem like the US in the mid-thousands. It will be at the margin. There will be property bills that fall over. There'll be builders that fall over. There'll be highly geared, late to the party, off the flat buyers who've bought 3 or 4 off the plan. They'll be hit hard. But I don't see that bleeding into a banking system problem like the US had with subprime. So it'll be at the margin. There'll be pain. But it will be at the margin. It won't affect the broad Australian economy. There'll probably be a recession, but it won't be a massive collapse like the GFC in the US.
Now, it's unusual that we're actually only a matter of weeks away from an election here in Australia, but it's gathering very little attention because there doesn't appear to be much of anything in the way of policy out there at the minute.
Yes, I try not to get into political comment. I'm more worried about markets. So I've done a lot of work over the years, which I'll do on my next report when the election's called. You know, which side has been better for share prices? Which side's been better for government debt? Which side's been better for inflation? So I can trot all that out and update that. The answer is actually quite interesting. And the same for the US. You know, which is better, left or right, Republicans or Democrats? And the answer is share prices don't have a lot to do with politics. Some cases they do. In Australia, there's more than a few examples of incumbent governments trying to destroy or nationalise private wealth. In the 60s and early 70s, in the 70s, the Labor government tried to nationalise Woodside's gas fields in North West Shelf. They tried to steal it at a price from private shareholders like you and I. In the late 1940s, again, the Labor government federally tried to nationalise the entire private banking system and all the banks, you know, Westpac, ANZ, NAB. They tried to nationalise all banks in Australia. I've written about that as well. So there's a couple of cases where, in all cases, it's Labor, but that's philosophically, they tried to nationalise and basically confiscate wealth from private individuals. I'm not suggesting it happens again, but it's not true to say that governments are benign. In every country, including Australia, governments have done some nasty things to industry and sectors of industry, let alone things like tax and regulation to specific industries. So this election, you quite rightly say, nobody's going to give any policies on anything. Labor lost last time because they had promises on franking credits and superannuation, more taxes or change taxes, capital gains tax rules, and they were easy targets to pick and say, we're going to raise taxes. They're not doing that again. They're not stupid. I'm not going to comment on who might win, but it is very hard to judge economic outcomes and market outcomes given that they have no policies, and what's driving it really is the Fed and to a lesser extent RBA policy, which are quite modelable and quite discussable without talking about the election.
Very good. And as we sit today, we're about a week away from the end of the quarter. So we begin to move into the sort of the asset allocation review and the outlook for then the next few months ahead.
Yes.
What's top of your mind beyond the interest rate outlook?
Well, there's two themes which have been present for a couple of years now. One theme is, are you fundamentally okay with shares or not? We've been pretty much neutral on shares, meaning we're fully weighted in shares. Yes, they're overpriced in a lot of sectors. Yes, there was a massive tech bubble which has come off. We've had a revival of commodity prices and iron ore and oil and gas and coal and metals, particularly in gold to some extent. So that's driven the Australian market up more than the US market. So the Australian market fell a lot less in the war crisis because commodity prices are good and commodity prices rose. So the BHP's, Rios are paying out these record dividends. So that's fundamentally good for Australia. And also the entire theme of the military build-up, the infrastructure build-up, that's good for commodity prices as well, albeit with inflation, which we've talked about. But commodity prices as a theme is very good for Australia. So Australia will do well. I've written a story many years ago, just tracking the fact that over the last 150 years, the US stock market and the Australian stock market have pretty much delivered the same real returns over time. What's different is, and we all follow the same booms and busts with very few exceptions. When we rise, they rise, and vice versa. We just follow the US. The difference is every bust through that cycle, we take turns in having the bigger bust and the bigger boom, the bigger bust. So for example, the dot-com boom in the late 90s was far bigger for the US. US rose far bigger, higher than Australia. We had very, very few dot-com stocks. And therefore, US crashed heavily in their tech wreck in 2001-2. We crashed very mildly. Take it forward another half decade. The next cycle, the China boom, the credit boom, the commodities boom in 2003-8, we had an almighty boom, far higher than the US boom. Therefore, our crash in the GFC, even though the GFC was a US housing problem, because our boom was higher in the 2000s, our bust was bigger in the GFC. So, and you go back in 87, we had a much bigger takeover boom with the bonds and SCASES and Elders. We had a much bigger boom in the 80s. So our 87 crash was much bigger. So those, you can go that, I track that pattern back to literally Federation to show how each boom and bust is in parallel, but they take turns. In the post-GFC boom, the tech boom, the Apple, Google, Microsoft, Facebook, that boom, the US is much stronger. So the US market post-GFC is run ahead much higher than Australia. Because of that boom being bigger in the US, their bust, which is coming, and we've seen part of that in the tech stocks already in the last year, their bust will also be much bigger. So as a little mini picture of that this last few months, Australia has sold off a lot less than the US in the reaction to the war. So that's a theme. We follow the same path. We follow almost exactly the same ups and downs, but we take turns in the bigger boom and the bigger bust. The post-GFC boom in America was bigger, big tech, all American. So therefore, there's sell-off, and we're seeing some of that in the tech area now.
Albeit, I'd ask you a question then on that, Ashley, where someone might say, well, the argument for that is then should we not have a very heavy home bias and have a big, heavy weighting to Australia rather than international shares?
Yes, home bias is a fascinating topic. The textbook says the Australian stock market is 3% of the world or 2% of the world, and therefore a good diversified portfolio should have Australian shares as 2% of the world shares. That's obviously very extreme, and some countries adopt that. If you go to New Zealand investors will say, I don't want New Zealand stocks, give me BHP, give me ANZ, give me Amazon. So New Zealand have a very healthy sense of the world, and they know their stock market is crap. Just give me out. They've got some great companies like Fisher & Paykel Healthcare is the best stock by far in the US in the healthcare space in New Zealand, but it's not. It's a very narrow, small market.
They're cognizant of the fact of how small a portion of the global pie it makes up.
If you go to America, Americans are very America-centric. So I went to school in America. They understand the four walls of America and maybe the kings and queens of England, but that's it. They're very American-based. So it's very hard to get an American to think outside America. So Australia is in the middle ground. Australia has always been very home biased. They like the Woolies and the Coles and the familiar names, and they've done pretty good over many, many years. So it's always been hard to get Australians to think about funny stocks in funny countries overseas. So Australians always had a big home bias. So our portfolios are actually skewed towards more global, but there's still, if you look at a portfolio, every one of our portfolios, they're pretty much half Australian equities and half global shares. So plus you've got franking credits, which is very powerful. Plus you've got the commodities boom. So an argument would be One is, do we like shares in total versus defensive or cash? And the answer is, we're still okay on shares. We're not super bearish like a lot of people are, nor are we betting the house and gearing up. We're basically saying shares have been strongly supported and most likely they'll continue in that same vein. Second question is our bias toward Australian shares being half the entire global pie. It seems about right given our commodities and our franking credits and the fact that we haven't got this massive tech sector which is selling off. So that's a second question. The third question is, on the defensive side of portfolios, what do you do? If you put it in government bonds, which is a textbook answer, you get clobbered as yields rise. So we've had very few government bonds in portfolios. We've got some corporate bonds which are high yield, but still investment grade, which has done quite well as well. They've held up better than government bonds. But most of our defensive side of portfolios still is in high grade floating rate securities. Why floating rate? Floating rate rises, the returns rise when cash rates rise, and cash rates
your yield picks up as the cash rate rises. Correct. And you don't have the negative capital impact of the rising yields.
So they have almost no negative reaction to rising inflation, rising bond yields, because they've got no term in those. They're basically priced off 90-day bank bills. So the floating rate high grades, it's only paying 1 or 2% yield at the moment, but it'll rise as cash rates rise versus negative returns for bonds. So those three questions: shares, like it or not. Number two is within shares, Australia, global, some sectors. And three is on the defensive side, what do you do with it? And we'll be discussing all of that in great detail and telling you about that at our meeting in April, which is coming up in a few weeks' time.
Excellent. Well, very much looking forward to it. Ashley, thank you very much again for your analysis, and for all our listeners. If you haven't had a chance to read Ashley's monthly update in early March, talking about those matters that we discussed at the outset of the call, I strongly encourage you to do it. One of his best ever. But thank you, Ashley. And thank you, everyone. Have a wonderful day.
Good evening.
Take care.